Okay, before we head in today, a few announcements from the applied level side. Monday, going up for AI for finance. There'll be one video looking at Disney. We're going to look at 18 quarters of Disney using Notebook LM. We'll show you how to put the 18 quarters in the least painful way, and then how we can use this with Notebook LM. We'll be putting two videos up for this series. Logical fallacies. This is continuing on with the critical thinking part. And once we're done with this, we will have AI assess Sam Altman's blog, The Gentle Singularity, where he claims that we have already passed that point, however gently, but we have passed that point. And then we'll look at a journalist who did a story on the blog, and we'll assess them for fallacies using AI. The interesting thing here is you would not know how to ask AI for this unless you knew how to ask AI for this. Like, unless you had some understanding of what a logical fallacy was, you wouldn't know to ask about a logical fallacy. So, paradoxically, as good as AI is, it does not alleviate your responsibility to learn. In fact, it heightens the return to expertise. Costa Rica, we have 6 spots left out of 30 for the August and September retreats. Only 6 left, and as I'm looking up, I'm seeing in my email a request for information from one, so maybe 5. So if you have an interest in that, send me an email and I can give you some information. Monday at 5 p.m. This is June 16th, live on YouTube. I'm doing a live feed. The topic here is AI and the CFA designation. There has been a lot of concern that, well, why should I even bother? AI is only going to take most of these jobs anyways. I'm not going to push back against that. AI will take a lot of them. So we're going to have a conversation about what it means for the CFA designation. This is happening today at 1 p.m. on Discord. But if you're not on Discord, then you'll have to wait till Monday at 5, and I'll do it live on YouTube. If you are on YouTube, you can get on the Discord. All you have to do is go to markmeldrum.com. I'll write it out for you. It's my name, right? markmeldrum.com. And you can register for free. And then you'll see a little under videos, you'll see something that says Level 1 2018. Click on that. And you'll get a screen up, and on right there on this part of the screen, you'll get a listing of all the videos. And right there, you'll see Join Discord. So you can join Discord, and then you can join in at 1 p.m. Today for the stage event. Also on Discord, Wednesday 4 p.m. June 18th, a Fed debrief after the market closes. On the FOMC day, I'll do a market live feed that day. Okay, let's head in. We got a lot to cover this week. I think I say that every week. A lot has happened, because a lot does happen, but this week was particularly intense. CPI and PPI for ZQ, this was wonderful, especially the next day after PPI came out. The increase in the index price was nice, but TLT, the long end of the curve, just saying, you know what, you can tell us all the good news in the world, we no longer care. So we're going to spend some time on that this week to figure out, why does it not care? 4 months, this is headline up here. You can see for the last 4 months from February, 0.2, negative 0.1, 0.2, 0.1. This is core down here, 0.2, 0.1, 0.2, 0.1. Contrast that with the previous 3 months. You have 4 months where the annualized number, when you look at headline and even the super core, is at the Fed's target. We're there. If you look at the month over month for headline, it's 0.075. They rounded up to 0.1, but it's 0.075 or 0.9% annualized. Half the Fed's target, 0.9 annualized. Year over year, 2.4. There is the 2.4 over here. The core, 0.13 month over month. Annualized, that's 1.57%. year over year, 2.8. That is where they get the 2.8. And the Fed really should be setting rates for the anticipation of what's about to come, not based on what has happened over the last year. That means we take a shorter time frame and we annualize it and see what we get. These are very benign. Look at Supercore, 0.03. This is just the core removing housing. Year over year, 1.85. Annualized is 0.37%. 0.37, that means you are flirting with deflation, or at least soon you'll be flirting with deflation looking at the Supercore, 0.37. And again, that is for 4 months running. Head to PPI. This is final demand for goods, final demand for services. It's just the other side of CPI. This is what consumers pay and only what they pay for. This is what businesses receive, regardless of who paid for it. Final demand for goods, 0.2. Final demand for services, 0.1. We look at less food and energy. For goods, you get to 0.2. Again, 4 months in a row that you've had rather benign numbers. And May does reflect 10% tariffs. It does reflect the 25% tariffs on aluminum, steel, and on autos that aren't USMCA compliant. So May does reflect some of that already. I think it's a little too early to see the AI effect in prices. Where we're going to see the AI effect is in the job market. We're already seeing early indicators of that and early signs of that, but I don't think it has hit the numbers yet. So let's just put that in perspective. AI is going to be a productivity enhancing tool. It is going to lower unit costs, which on a competitive basis should lower pricing. I think it's going to be massively deflationary. We've had 4 months of very benign readings and we haven't even hit the effect of AI yet. But we also have the conflict in the Middle East. Israel has attacked Apple's worst product ever, the Iran. And Iran hit back. There's a question about what's going to happen with energy prices. And I've heard, or at least seen, opinions about it ranging from we could see 120, here's how, Wall Street Journal, all the way down to no, this could crash into $40, OPEC stands ready. I don't know which one. We're not going to know. I'm doing this at Sunday. It's 8:43 a.m. I have no visibility at this point where futures are going to open. Bitcoin's offering really not much of a glimpse into how to view this risk. It's neither up nor down. It's kind of just flat, so I can't read anything into that. I won't have visibility to 5:15 when the currency market opens, and then at 6 when the futures market opens. We'll get something on Brent, which has the ticker BZ, and something on West Texas, which has the ticker CL. We'll see where that opens up. It does have the potential for an energy shock. Now, you can have prices, oil prices, drift upwards over a period of 8 months to a year and go from $60 to $100, and the economy will absorb it. What you can't have is 60 and a big, massive increase that quickly. That is called a shock. That would be a problem, both for economic activity and for prices. Right, that would be the classic definition of, well, what would really be stagflationary, a major energy shock. If you go back to the 70s, this is really interesting, by the way. You had one big bout of inflation that started to come down, and then you had another bout of inflation, and then Volcker came in and crushed that. Do you know what this second one was for? Iran, the Iranian Revolution, and the increase in energy prices. And where are we now? We had one big bout of inflation and it's coming down, and you have a common underlying causal effect here. If they close the Strait of Hormuz, that could be very, very bad. You could see prices skyrocket again, and we would have the Iranian pattern in the charts. And 50 years from now, economists would say, well, we just had a big bout of inflation. Eyes on Iran. They're about to do something. So I think this, without this, I think it would have been a mistake, a big mistake for the Fed not to cut on Wednesday. I still think they have permission. A 25 basis point cut isn't going to affect the long end of the curve at all, and that's really where the restrictiveness of monetary policy has its greatest effect, is in the capital markets, because all debt is priced off the capital market. What they would be doing is lowering the government's cost of its money market issuance. It's 1 month T-bill, it's 1.5, and the 2 month, the 3 month, the 4, the 6. It would lower the cost of that. And I don't think it would affect the long end of the curve very much. So if I were on the committee, I'd say, look, I think we can go 25. I don't think it's going to decrease conditions on the long end of the curve. And if oil prices spike, you're going to want some kind of restrictiveness on the long end. The short end doesn't matter. We can cut 25. I still think they have permission, but given this adds a new level of uncertainty, and I'm sure the Fed will use the words an abundance of caution. An abundance of caution, because what lies ahead? Reciprocal tariffs. We don't know what they're going to be, but Trump seems to have indicated that he's willing to move it up 2 weeks. 2 weeks. And I have a theory of why he doesn't want to wait, or why he can't wait till June 9th, or why he's saying what he's saying now. But they're not gone. The court that put aside the first court order that says that he does not have the power for this, isn't hearing arguments till July 31st. So he has plenty of runway to show that he's a tough guy, right? He's not a chicken, So the taco trade, I don't think that that's going to be the trade going forward. So we have that in front of us. So yeah, okay, the Fed can point to, we don't know what the effect of that will be. And depending on how Monday, Tuesday, Wednesday perform in terms of energy prices, if oil is pushing 80, then 82 and 84 and 86 and 90, yeah, you're probably not going to get a cut at this meeting at all. Okay, let's revisit the job market. We had initial claims last week, and we had another week of elevated claims, 248,000. But the trend that's beginning to appear is in continuing claims. And look at this right up the side of the chart. These are both 1 year charts, seasonally adjusted, right up the side of the chart. This over here, 248. This is saying that businesses aren't really eliminating a lot of people, because that would be elevated. That would be over 300,000, 350 if there were layoffs that were occurring at a more rapid pace. This seems elevated but normal. They're not really eliminating, but they're also not hiring. This is a headline, not a headline, but a title from Oxford Economics of a research briefing May 27th. Educated but unemployed, a rising reality for U.S. college grads. The last line here, there are signs that entry-level positions are being displaced by artificial intelligence at higher rates. Having used a lot of the models now, and not just the language models, the reasoning models. I've used some of the visual, creating video, creating audio, creating images. I've used a number of those. I would say, well, duh. I mean, if you're saying this, well, duh. That seems to make a lot of sense. That if I can have my current staff use these tools and increase their output, I don't need to bring in as many new entrants as I did before to get that boost in output. So to me, it seemed like a no-brainer on this one. So even here with the initial claims, you can if you sort of find a line of best fit since the beginning of the year, it has been trending up. And here, after going sideways for quite some time, you have this, which is troubling. Is that an anomaly that is going to, because we've had this before where it's gone up and then come right back down into the range. Is this an anomaly that's going to come back down, or is this going to continue on, and does this start trending? Does this trend keep going this way, or again, is it just that, look, once we get the tariffs behind us, we can move ahead? Because it's hard to figure out what it is. It could be AI. It is a legitimate technology that is general purpose, that is a plausible reason why job growth could be slow. You have uncertainty because of tariffs, and companies don't like to invest under conditions of heightened uncertainty. That, look, this is not for the next 20 years. This could be for the next 18 months when Congress and the House shifts to the Democrats. Could be the belief, or it could just be for the next 3.5, 4 years until we get a different administration. Why would I invest billions and billions of dollars under those conditions? So it could be that a lack of investment, lack of employment, increased productivity because of AI, lack of employment opportunities. Tariffs, maybe once we get the idea of tariffs out of the way, companies will say, okay, now we can do this versus do that. So there's a lot of uncertainty. So I don't know that we can conclude what this is. But this is both these trends are concerning. Given these trends, given these kind of statements, given that you can just Google the effect of AI and you can see that companies are saying, yes, it is affecting hiring decisions, it is affecting employment levels, yes, it is. Given where inflation has been for the last 4 months, even in the face of tariffs that are in place now, I do believe the Fed has permission for a 25 basis point cut. That if on Wednesday they came out and said, okay, we're cutting 25 basis points, I don't think that I would be surprised. But he does risk that title becoming all too true, too late. He was late in raising, or I shouldn't say he, the committee was late in raising prices. But you could say he, because the committee really is a reflection of the personality of the leader to a large extent. They were late in raising. Last summer, I thought they had permission to cut in July, and they didn't. They went 50 in September, which at that point to me seemed a little too much. Like, why go 50? Why not just start at 25, right? And now you don't cut. What's going to happen down the road? You're going to have to go 50, 75 basis points. Okay, looking at rates and yields, money market rates still all very well behaved, although the 2-month, that's a curiosity there. Capital market curve is lower than it was last week, roughly about 10 basis points across the curve. Justifiably so. You had a good read on CPI, a good read on PPI, a well-bid 30-year auction. And then Thursday night, I was watching the aftermarket, because I have my screens on till 8 o'clock, because that's when aftermarket ends. And right around 7:57, SPY started making big red bars down. And I was short a bunch of shares. I had shorted 5,000 shares early on Thursday morning. And I saw that happening. And usually when you get those kind of big moves that fast, it means there's an event somewhere. There's no time to go looking around and figure it out. The short position was paying off big, so I was covering 1,000 shares at a time. And as I was entering in my order, the price of the market was falling faster than I can enter my order, and I had to keep moving my limit price down as fast as I could. And then 8 o'clock happened. TLT had very good response, and then it all faded away the next day, and that made me think, why would it fade away the next day? What is going on that it makes it fade away the next day? Because this doesn't look like it's over. Maybe the worst version of it might be avoided, but it doesn't look like it's over. And given everything that we've had this week, a good 30-year, good CPI, good PPI, why can this not hold its ground? And I think I have a theory. So we'll look at that. Because everywhere I look, I'm not seeing a disregard for treasuries. I'm seeing a demand for treasuries. So it has to be something else. So we're going to look at that. Because if there was a week where the long end of the curve should have performed, it was this week. It had all the reason to perform, and what did it do? It eked out a 1.15% gain. SPX lost 0.39. This is troubling. This is a problem. The dollar index. The dollar got a bid on Thursday night as well as this was unfolding, and then just started giving it up. But gold did what gold was supposed to do. Bitcoin did not. Can we put to rest that Bitcoin is a store of value? Can we put to rest that it's a hedge against inflation? Because when inflation showed up, it went straight down. Can we say what it is? It is just a risky bet. It's not an asset. It's simply just a risky bet. The risky bet didn't perform well. The safer bet did. June 18th, 3 days away. And we get the summary of economic projections. Why is it that every Fed meeting, I think this is going to be a big one. This is going to be a big one. Every Fed meeting is a big one. This has to end. The Fed meetings are supposed to be in the background and boring. When they're front and center like this has to end. Let's see what the SEP says. I think they're going to suffer from the words abundance of caution. And I think the moniker too late is going to stick with this guy. It's going to stick with this committee. The too late Fed went from 94.6 to 96.9. Initial jobless claims higher, continuing claims higher, CPI lower, PPI lower. Okay, let's go with a greater probability of no cut. Greater probability of no cut. Retail sales we get in 2 days. We get that for May. More inflation data here. Export and import prices we get for 2 days. Who cares about export prices, right? That's what the price you're charging to the rest of the world. Let that go up as much as you want. It's import prices that are more important. We get that 2 days in May. And on the Canadian side, Meldrum, Wednesday at 11:15 a.m. Reverse repo, 168 billion. Reserves, 3.4 trillion. That is elevated. The TGA, Senate better pass that bill. Raise that debt ceiling. You're at 227 billion. Last week was what, 340 billion? How much longer can you go? Special measures coming up. Monday we have an auction, the 20-year auction. This is the last time there was a 20-year auction. It didn't go. The thought was, it didn't go well. The 20-year is an odd tenor. There it is right there, right? You have the 10-year, you have the 30-year, and you have always an elevated yield on the 20-year because it doesn't have a very big clientele effect. If you're in the market for the 10-year, you don't want the 20 or the 30. If you're in the market for duration, you want the 30. The 20, like I say, it's an odd tenor. It doesn't have a big client effect. I don't know why it should move the whole curve. It should just be its own reflection, but just be aware that was the issue last time, Monday, and all auctions are 1 p.m. We have that. Look at the 3-month to 10-year curve. We are inverted again. We uninverted. We inverted a little bit for 1 week, came right back up, and now we're inverted again. It's so small. We can say we're flirting with the zero line. We're just sort of bouncing around there. Canada firmly upward sloping on the capital market curve and the money market to capital market curve. Looking at Fed funds futures, Q2, call it nothing. 1 basis point, that's just positioning and hedging. There's nothing going on there for Q2. You could just say that's off the books altogether. Q3, 21.5, Q4, 28.5. Now if we get rid of this one, that is exactly 2 cuts. That's exactly where the SEP was last time. The market is converging to the SEP, and in 3 days we get a new SEP. If it still shows 2, then no move, no cut, and still shows 2, ZQ would probably have a little bit of volatility and then just recenter back on where it is now. If it prices in one cut, well, I'm going to lose quite a bit on my ZQ position. We'll see what happens. Q1, another 20 basis points for roughly about 3 cuts in 8 meetings. I am long the October ZQ. I am long the January ZQ. I'm long the May, and I'm long next October for a total of 42 contracts at this point. A total of 42. If we got to the point where the market believed there would be no cuts this year, no cuts, I would be underwater by a lot. This would drop very quickly towards this price here if they believe that. If that happened, if this curve started doing this, I would probably take next October. If October dropped a lot, I'd probably go for 1,000 contracts right out of the gate. That would be an underlying of $4 billion. Wouldn't that be wild? But I would do that because I don't believe that they're forward-looking enough. I think they're too stuck in the data of the day and backwards looking, and I don't think they're forward-looking enough. I think they will be wrong. Real rates. We're going to spend some time here this week. Look at the 10-year, the 20-year, and the 30-year, 2.2, 2.5, 2.68. Those are rather high. The 7-year at 2%. The 30-year real yield, a new cycle high of 2.75. That wasn't just a cycle high. Here's the 30-year down here. You can go all the way back to the very beginning when the 30-year was reissued. This is February 22nd, 2010. It is the highest in the history of the 30-year since it was reissued. That was the 30-year before. That was discontinued and then it was reintroduced. It's the highest since the issuance of the 30-year at 2.75. We're sitting at 2.64 now. Last week we're at 2.68. I circled the wrong ones. I should have done this. This is where we are. This was last week, but still, it still holds. We're still rather elevated. This is the 10-year real, going all the way back to 2008, June 12th, 2008. I just tried to go back an even number of years because we're at June 12th here. You got to go from where we are here, from this recent period. You have to go all the way back to 2008, 2009 to get real rates at that level. All the way back there. 2.13, 2.64 here, no matter how far back you go, right? You only have to go back, once you hit May 21st at 2.75, that was it. That was the highest. High real rates are usually negative for equities, not high nominal rates, because you could have very high nominal rates with a very large inflation component in there and a very low real rate. And inflation is a rise in the general price level. Well, where's that price level coming from? It's coming from all the companies that are selling their product at higher cost. So revenues would be increasing at that rate of inflation, but profits would be discounted backwards with a cost of capital. With a very low real component in there, it's not too damaging. But if you have a very low inflation component, which we do now, but a very high real rate, the inflation component being low means that the prices aren't increasing that much, so you can't expect revenues to grow at this big. It has to grow through economic growth, not through inflationary pressure. But you have this elevated real rate that's typically negative for equities. But equities don't seem to care. We've had a couple of weeks now where the economic data is, that's not great, and equities just say, no. Either ignore it or look past it. If we can't ignore it, let's just look past 2025 to 2026. I've heard that a couple of times. We're actually looking past 2025 to 2026 earnings. Rather than dealing with, you're right, it's not that great, well, then look past it. And if you can ignore it, ignore it. Well, it's got the effect of this and it's got the effect of that. We're ignoring this. This is a trend that's going on. Yeah, but we're looking past it. Look at these high real rates and the low inflation component. Yeah, we're what? Ignoring it, looking past it, or not even paying attention to it, or not even aware of it, not even looking at it. To me, this is troubling. Something is wrong. Either the real rates are too high and they've got to come down, or the equity market is valued too much and it has to come down. One of these markets is wrong. I'm going to make the case later that both markets are wrong. Not that it's not one or the other. There isn't a dichotomy here where I got to pick one or the other. They're both wrong. Let's look at OAS. Nothing going on with OAS from week to week, very little to see. But we do have the high of the cycle. And here I've given you the low of the cycle, the lowest it's been since the interest rate hiking cycle began. And the date. So the IG index has been as low as 0.77, November 8th, 2024. And as high as 1.71, this is October 21st, 2023. So what I did is I took the range, the full amount of basis points in the range, and divided it by this range. We're 11 basis points off the low, so 0.11 divided by the full range. Now that is just a percentage based on a uniform distribution. We're 11.7% above the low. Said another way, it's 88.3% of the distance away from the high, right? So nothing to see here, 11.7. Even the high yield index, the low was 2.59, the high 599. We're sitting at 3.17, and I don't have this filled in. Let's have a look at my notes here. This was January 25th of this year. So we're 17.05% above the low. In investment grade, we have AA and BBB. AA, the lowest was 0.43, sitting at 0.49. The highest was 0.98. This is 10.9% above the low. This has a point. Just bear with me. BBB, low was 0.97. High was 2.1. We're at 1.1. That's only 11.5% above the low. BB, 9.78% above the low. But look at CCC, 40%. So there is some stress showing up there, even though we really can't see it from week to week in what's going on with the OAS, the change. If you look at where the low point was, the investment grade index as a whole is, the OAS is 11.7% above the low. The high yield is 17% above. And in investment grade, you have 10.9, 11.5. Even the higher end of investment grade, 9.78, but 40%. Triple to 4 times as much in a percentage basis off the low. So there is some stress showing up. We just had to dig around and find out where it was. Okay, let's head over to SPY. Forward 4-quarter operating earnings holding fairly steady at just a little under 270. Closing SPX 59.76, so we're 22.17 on the forward operating earnings. That's not the as reported, that's operating, right? Versus 22.25. Implied volatility is back. 13th week percentile, 38th percentile now. So there is some premium in put selling. And I did sell some puts. In fact, I was very active on Thursday night with the equities and on Friday. Thursday we're closed, Juneteenth. So Monday, Tuesday, Wednesday. And then we don't have the benefit of Thursday. You jump all the way to Friday. So I think the Wednesday is going to be, well, you got to crowd all of Thursday's trades in a Wednesday. All of what's going to happen Thursday's got to happen in a Wednesday. And then Friday, let's see what happens there. All-time high still sitting at 612.30. We're 2.47% below the all-time high. And at on Thursday, it did look, after PPI, like it really wanted to make a run. I think it was printing 606, 607. I shorted the market early that day at 602. 602.57, 5,000 shares. We'll talk about my shorting down here, but I hit it again at 5,000 shares. And it sold off during the day. It was quite nice. And then even into the evening, 7:57, when I saw those big red bars. I don't know what this is, but I'm going to take it. IWM. This is a disjoint here. We're going to talk about this shortly as well. Look at triple Q, 2.53% below an all-time high. The SPY is 2.47% below an all-time high, but IWM, IJR still in correction territory. 13.67% below, 16.12% below. As far as earnings coming up this week, still can't agree here. It's so frustrating. The notable ones, Monday is Lennar. Friday you have CarMax, Darden Restaurants, and Kroger. And yes, I am still shorting. I took a position that as long as this administration continues to be king-like, continues to be dictator-like, as long as Congress is absent, this is a rookie group of people who have no execution ability and no execution skill whatsoever. They can only make things bad. If they make things good, it's by coincidence. I don't think that they have the intellectual horsepower or the intellectual skill in dealing with complex systems like economies. I don't see it. So as long as they still have full authority, I say short these markets. So yeah, on Thursday morning, after what I thought was a long enough ridiculous run, I hit it again. I have been short all the way through. All the way through here. I had sold calls. I had 540 calls, 550 calls, 570 calls, 563 calls. So I am short calls at all of these. But you have to be tactical when you're short. You can't just, it's not the same as being long. Being long, you can buy and go away. I'm long a lot of Canadian REITs, Canadian banks, and day to day, I don't even look at that stuff. I don't even care. I don't have to be tactical, but when you're short, you have to be tactical. And what you don't want to do is every day that it's higher, short more. That's a losing proposition. You want to hedge out as much as you possibly can until you feel that whatever was causing that rally has run its course. I feel that this has run its course. So now I'm back in. So basically, that almost doubled my short position because this represented close to 5,800. Roughly, if you're thinking in terms of dollar delta beta, this was very close to about 3 million in dollar delta beta. This doubled it to about 6 million, negative 6 million in dollar delta beta terms, because these are calls, but a 540 call is going to have a delta of like 0.9697. It's almost the same as being short the shares. What I think is going to happen is we're going to move from a taco trade to an ego trade. Trump's not a chicken. In his own head, he's not a chicken, and he's being called a chicken, and he's going to show you. His ego is going to be more important than doing the right thing. It's got to be the right thing for his ego at this point. Now, this is my assessment of the personality of the man. This is the framework that I work under. You can disagree, say, oh, I don't think he's like that. Well, then that's fine. You go ahead and you make decisions based on what framework you're using. This is the framework that I'm using. And I think he's going to show that he's a tough guy. So I don't think these tariffs are over. I don't see a lot of trade deals. The idea that we have a trade deal with China. No, you don't. What you agreed on was a framework to agree on something. If you read what happened, they agreed to a framework to stick to what they agreed to. That's not a deal. That's just you agreed. It's and the same with the UK. It's not a deal. It's just an agreement to begin a talk about an agreement that might take 18 months. We agree to talk about an agreement. I don't think that that the rest of the world is beating a path to the White House door to negotiate a deal on this one. But I do think that Trump, being called a chicken, is going to overcompensate for this now. So I do think that we're going to see, and I don't think they're going to wait till July 9th. He has indicated that it would be moved up by 2 weeks, that he's going to start sending letters out. Who sends letters? But anyways, he's sending letters out to force people to come and trade. This to me seems like these are just, I think, just threats. Is that, look, everyone's making deals. Either you come to the table or you're going to be punished. You don't want to be the one left standing outside the door. And I think everyone on the other side says, does he think this works? You know, does he think that I don't have a phone, that I can pick up the phone and call all the other leaders and say, you going? No, you going? I'm not going. Are you going? I'm not going. Is Dave going? Dave's not going. I already talked to Dave. What about Debbie? She going? Debbie's not going. Like, you know, I mean, they can all talk to each other. They are all trading partners to some degree. I don't think that there are trade deals out there. I think the taco trade is over, and I think the ego trade is going to show up with a vengeance in the next few weeks. So I'll explain how I handled Thursday night and why I did what I did. I had already put this in the positions video, so those in the applied level got all this information on Friday. Early in the morning on Thursday, based on my analysis that ego was going to be more important going forward, not taco, I took a 5,000 share short position. I think at 602.56, 602.57, but after transaction cost 602.56. This was at 10:30 in the morning, and I was content to let that ride. But we got into, there's a chart, there's 4 o'clock, here is 8 o'clock. We had this kind of thing going on with SPY, and then you had this right off the side of the chart, and here's 8 o'clock when aftermarket ends. So when I saw it dropping, I covered 1,000 of the 5,000. It's still dropping, I covered 1,000. It's still dropping, I covered 1,000, and then it was done. You have to go into overnight trading, which isn't a big deal. You just have to change platforms to get it done. So fire up IB on the desktop to get that done. Look around first, and it was the attack. Well, that's an event. Israel has done that before. Israel has struck Iran before under Biden, and it really didn't amount to very much. It was just an event. So the event you cover. Even though I was willing to hold that for a while, it was very likely the market was going to do this. So I covered the 5,000, and I even went long at that point. I went long, which starts to minimize the short effect on the call, because my bet was this is an event. I don't have enough information to know whether this is going to be a trend, but Iran cannot fight a war against a U.S.-backed Israel. They would lose. And I think the clerics know that they would lose, and the clerics don't want to lose power. But they can't look weak, so they're going to strike back in a way that the Iron Dome is going to pretty much, destroy their missiles in the air. And if you were watching Al Jazeera had some good video of this, over Tel Aviv, of the missiles coming in and just, in midair, pop, 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 pop. A few of them got through, but most of them were well defended. I haven't looked at where we are on that situation right now, but no headlines have popped up through either Barron's, Wall Street Journal, CNBC. If there was something big, I would have gotten some kind of alert. So the next day, what I did when I saw everything calm down, the market went up. I sold calls against these long 1 data expiration. Well, actually 0 data expiration, sorry. They expired Friday. I sold 0 data expirations against this, and I sold at 602. I sold 50 0 data expiration calls. That if it finished above 602, I was happy being short again. I got 85 cents for that. So 42.50 for the entire contract. And it started to drop. I think I covered at 11 cents or 9 cents, and flipped it over to June 20th. Another 50 short, and I think I got 384 for those. And the market continued to drop, and I covered these at 260. So another $5,000 gain over here. And then I started selling 570 puts. Whoops, 570 puts for June 20th. June 20th, which is Friday, I started selling a bunch of 570 puts on the way down, because I have calls at 540, 550, 560, 570. So basically I now have a straddle on this one. I don't see it dropping to 570 in the next 5 days. But if it does, well, that's okay. I still have these calls below. This is what I mean about being tactical, is you have to read the situation. And even if you have a short position, you do have to recognize sometimes that today's not your day. And if today's not your day, hedge, take the money, take the money. So with the use of the 0 day to expiration options and the ability to roll these over every week, you do pick up premium every single week that you roll over. Now, I don't roll these over every week. These are sort of on a rotating basis. I roll them over for 1 month, but every week something is ready to be rolled over. So every week you're rolling over something for a month, so you have this kind of maturity. You know, this week these mature, then those mature, then those mature. So you take these and you roll them to the end, and then these mature. You take those, you roll them to the end. So you follow that kind of laddered option, and you're picking up $2 to $3 on the premium each time you roll them. And every week you have something coming due, so you have some near-term gamma that's working for you if you do have a turn down in the market. This was an event. There wasn't enough information to determine whether we're going to have a trend here, but this was an event, and I do expect that this event will go away, because I don't think Iran wants this fight. They don't want to look weak, but they don't want this fight. So I am still going to hit the market again. If I see 602, 603, 604, if I see it trying to do that again, I'm going to hit it with another 5,000 shares. I am comfortable there because my assessment of the man, and I don't have to assess the administration. There is no administration. That's why I'm doing this, because there's only one man to assess, and he'll go to the ego before he goes back to the taco. Let's take a deeper dive into beta here. On the next screen, I'll do a deeper dive into duration. On this screen, I'm going to lay out my argument and some evidence of why I think beta is wrong, and that a short position on beta, especially large cap, makes a lot of sense. Right now, I am short beta on SPY, but I am long beta on IWM. I'm long small caps, I'm short large caps. I have net positive beta up until last week. I'm still net positive now as of Friday's close, but I will be net negative beta because I am going to significantly increase my short on this one. Now, as far as my picks go, if you pay attention to, if you go back over the last 2 years and make a list of everything that I picked, I'm about 90% right on my picks. I just don't have timing. Oftentimes I'm early to a trade, and you know, if you're early, it can look like you're wrong, but I do have the ability to hold. I was short IWM, then I flipped long IWM, probably too early, and I am short SPY, probably too early, but I think now is the right time to increase my short position, as I've already done. Let's look at some normalized performance on some factors. This is 3 years, this is 1 year. And these are just factors, or at least as close to factors as you can measure, rather than looking at particular indexes like IWM, IJR. We'll look at the particular factors. This is over 3 years. This is growth versus SPY, outperformed by 15.74, and there's momentum. The only two good performing factors over the last 3 years, growth and momentum. The growth stocks usually are the ones that display momentum. So to see them both move in the same direction is not really that surprising. And what do we have at the bottom? At the very bottom here, you have small cap over the last 3 years. Really underperformed SPY, negative 28%. Moving up, you have value underperformed by 16.78, and you have high dividend, 15.75. It's typically the case that high dividend and value are pretty much the same stocks, much like momentum and growth have a big overlap as well. And then we have low vol. Well, we haven't had low volatility for quite some time, so that's not surprising at all. I don't know that that's very surprising over a 3-year. Let's look at a 1 year, and this green line here is day of liberation. Let's just look at what happened since day of liberation. Let's look at momentum. Momentum was almost flat and then just straight up. And growth was negative as of that date and slightly positive. Everything else is down. All right. Let's look at low vol. While we had a lot of volatility show up, that should not be surprising that that factor has not performed well at all. High dividend, straight down. And with that, we should see that value is down as well. Value is here, and that's down. You can see just the big drop off over here on that day of all of them. You can see the drop off, right? And this is small cap. Since that day, what has performed? Momentum. Momentum has performed. Always buy the winners. Buy the winners. Every time it pulls back, you buy the winners. Right. This is where we get these V-shaped recoveries from. You still have this momentum market that is performing. Let's look at JP Morgan's chart over here, which gives us Mag 7 performance and earnings. And this green line here, this is the performance of the Mag 7 in S&P. This is the S&P, and this is the S&P less the Mag 7. So if we look at the earnings growth of it, forget about 2021 because that was after the pandemic when everything bounced right back. So that's sort of an anomaly. Let's just look at S&P 500 x the Mag 7 and tell me how much of a forward multiple you'd pay for this kind of earnings growth. 9%, negative 4%, positive 4%, positive 7%. Is this something that you would say, oh boy, 22, 23, let's go 24 times forward earnings? Well, actually take out the 24, that's unfair, we haven't been there. 21, 22, 23 times forward earnings, not for that growth rate. You know, you 21 times forward earnings for a 7% earnings growth rate, your PEG ratio of 3, that's really, really expensive. But look at the Mag 7 here. You had negative 14, 31%, 40%, 17%. And you can see how it's really pulling up the index, the price of the index at this point, that if they weren't there. Now, there has been some question of, well, maybe 21, 22, 23 is the new normal. Maybe you're not going to go back to a mean reverting level of 17 or 18 times forward earnings. Waiting for that to happen is like waiting for Godot. It's not going to happen. It's just theoretical in your head. Here we can look for some sort of framework to simplify our thinking. Because if we put out the question, does it make sense? You could be all over the place with all sorts of variables to say, well, it's because of this, it's because of that, it's because of this. So let's think about we'll start from a basic industry structure of perfect competition, and we'll draw out an industry. Or better still, let's draw out a subsection of the economy that has 11 sectors. Let's just say this is the economy. It is the case that the economic profit will be driven to zero. If economic profit is below zero, you will have firms exiting. You'll have supply coming off the market, which increases pricing. If economic profit is greater than zero, you will have firms entering, increasing supply and driving down prices. Now, that is assuming that there is no impediment to competition, which means nothing legislative, nothing on the regulatory side, and nothing on the competitive side. Well, companies can have some competitive advantages. This is what we want. So that would move to a structure called monopolistic competition. And in the extreme, you get monopoly. But let's just start with economic profit equal to zero. If you had a situation where the moment you had economic profit greater than zero, firms would enter the industry. It would drive pricing down such that at the industry level or the economy level, you would get to economic profit equal to 0. Well, that's why, if that is an attractor point, that is why a forward multiple is an attractor point. All right, so let's draw two lines. This is economic profit, and this is the forward multiple. That if you had excess profit, you would have, for the existing companies that are there that are making excess profit, they would be bid up in price, right? Well, as firms enter the industry and drive the price down, it would lower the multiple as well. These would be almost mirror images of each other. By the way, for those who don't know what economic profit is, companies on their income statement report revenues and they take off expenses, and they'll get to earnings before interest and taxes. They subtract interest. They'll get to earnings before tax. They subtract tax. They get to net income. Well, interest is a cost of capital because there are two forms of capital, debt and equity. But the income statement only takes out one cost of capital, which is the cost of debt. But we know when firms discount their cash flows, they discount it at the weighted average cost of capital, which is the cost of capital and the cost of equity. Well, accounting profit only subtracts one cost of capital. So if you subtract the cost of equity, you will get, if you do have a perfectly competitive economy, you'll get to 0. Because if you can earn more than your cost of capital, that will attract funds. If you're earning less than your cost of capital, money will go somewhere else. So because this is an attractor point, the multiple is an attractor point. Now, you can have monopolistic competition. It would be odd for an index to have 500 companies all displaying elements of monopolistic competition. You can say, but utilities are monopolies. Yes, they are. This is why utilities are regulated such that their return must equal what their return would be if it was perfectly competitive. And this is how we protect consumers over something they absolutely need, which is utility services. We give one company a monopoly on utility services in a particular region, but we say your outcome must be such that it would be if it were perfect competition. So if you're wondering why utilities are regulated to earn their cost of capital, that is why. Their cost of capital. Economic profit just takes out the cost of equity, and that's why in industries that have no impediments to competition would, because of the allocation, the efficient allocation of capital, earn its economic profit, which would mean that if it has an attractor point, so does the multiple. Where the multiple can start to accelerate beyond that is where you start having impediments. Maybe it's characterized by more monopolistic competition, or it could be that some of the companies are near monopolies and they abuse their monopoly power. Has Google faced issues on that? Absolutely. Has Apple faced issues on that? Absolutely. Is it justified? Yes, it is. Has Amazon faced issues like that? Yes, they have. Is it justified? Yes, it is. In Apple's case, you want to get an app on their phone, you must go through their app store. They take 30% of your sales. If you're selling anything on your website, you must also offer it available in your app. They take 30% of your success, and you have no choice. No choice. Either you can't use another app store. There is no other app store. There is no other app. That's an abuse of monopoly power. If you start selling something on Amazon and you're successful, Amazon will start selling the same thing. And when people search for it, Amazon will push you way down in the search rankings and will put their product first. And they will put you out of business fast. That's evil. That's an abuse of their monopoly power. So these are monopolies. So combine this idea over here that the monopolistic competition are tending more towards the abuse of monopoly power. You're not getting a return to economic profit equaling 0. You're not getting that in, which means your multiple is moving, terrible color again, your multiple keeps moving this way because you have this going on at the industry as a whole, we'll say. Now this is sort of showing it over here. This is sort of showing it over here. Because if you look on the outside, this is reasonable. 7% earnings growth, that seems to be rather reasonable. Which would not justify a forward multiple of the shape that we have. So why be short? Deregulation coming in. Deregulation tends to favor small cap over large cap. One of the biggest drivers of regulation is not government. You may think, well, government has got too much regulation in place. It's not government. It's large businesses that want to protect their business. They tend to advocate for regulation that favors them but doesn't favor new entrants coming in because they've already got that cost covered or they've already jumped through that hurdle. We need better regulation here. We need regulation for this. Things that raise the cost of entry, but they're already in the business. It keeps competition out. If you deregulate, it should favor small businesses over large businesses relative to the performance of some benchmark, let's say. The AI effect. This has the ability or gives the ability for a lot of smaller businesses to generate output or raise productivity or not have to rely on trying to hire new people to raise their output. You get enough of these doing it, it increases output, it does lower prices. It is going to, I think, help small cap companies or smaller firms compete, but it will start nibbling away at the space that large cap lives in. Legislative effect, we're already seeing this. Google has already been in front of a judge that has deemed that they have abused their monopoly power in search. Apple's already facing this, and Amazon's already been through this. Microsoft has been through this in the past. All of the, when you get this, Facebook, all of these, when you get to that size, you're going to face some kind of charge that you're abusing your monopoly power. And we don't want a firm to have so much power because it does stifle competition and it is negative for the economy as a whole. So given that you have an administration saying we are going to deregulate, and I believe them on that, the AI effect is real, and it is not industry specific. It is a general purpose technology, and this legislative effect, I think, that is in place. All of these things don't favor large cap, they favor small cap. The other issue is for the last 15 years, we have trained a whole generation of investors and traders to look at only one pattern on charts, and that's a V. That you have something that looks like this and you have this. It's like, that's the beginning of a V. That's the first leg of the V, and they'll bet on the V. Much like, you used to see something like this on a chart, and traders would say, you got a head and shoulders forming, and down we're going to go. They look for patterns. There is only one pattern. Any drop like that is the first, that's half a V. It's half a V because it has always worked. For the last 15 years, the V pattern has worked blindly. The pattern is agnostic to the valuation. It doesn't matter what the valuation is. It doesn't matter what's going on. It's just as soon as you see the market drop, you're halfway to a V. How deep the V is, we don't really know, but if you can hold on, you're halfway to a V. I think that that's going to face some significant challenges going forward. Combine that with an administration that I think is incompetent in terms of its ability to engineer some economic outcome. I think it is incompetent in that sense. That the best way to engineer an economic outcome is to get out of the way of everything. But they are not. And I think they're going to keep going with these tariffs. The combination of all of this, I think beta is wrong. When is it going to be right? I don't know. That's the wild card. But I think it's wrong, and I think I'm on the right side of the trade by being short the large cap. So I'm short SPY. Yeah, my colors here. Short SPY, and I'm long IWM. Now, when you're short, again, you must be tactical. Not every day is going to be my day, and when it's not, I will use zero-day expiration options to be tactical. Let's move on to duration. All right, I'm going to make the case here that the long end of the curve, the 20 to the 30 year, mostly represented by TLT, is wrong. it's absolutely wrong, and that TLT should be much higher, except for the narrative. Now, you can have a narrative that says, oh, this is bad, but you could have the underlying market participants saying, no, it's not. But the narrative says it is, so you can have a layer of traders on top of a layer of investors where the investors say everything is fine here, but the traders say, well, no, we disagree. No, it's not. But they're not long-term investors. And this is what we have going on the long end of the curve right now, that you have some evidence that says there's nothing wrong here, but you look at the price and you say, but everything is wrong here. And I think it's only the price that's wrong. Everything else seems to be fine. To sort of understand where we are, here is a hierarchy of credit in terms of what you'd want to get paid. Treasuries are considered credit risk free. If you think that, well, maybe that's not entirely true, then you'd suggest that maybe they're credit risky and you need some kind of credit spread for it. If you think that, well, it's not just that it's credit risky, it's that nobody really wants to buy this debt, you would have credit stress. And if you got to the point where they're not going to pay you, they're just not going to pay you, they're going to default, that is a credit crisis. Let's draw a line here. And do we have a credit crisis? Does anybody believe right now that the U.S. is going to default on its debt and say, we're not paying you? Is there a credit crisis right now? You may say, well, in 20 years, 20 years is 20 years. Right now, no. Is there credit stress? Can the Treasury still sell its bonds? We're going to look at the results from Treasury auctions. The result is there's no credit stress. Credit risky. Do you believe you're not going to get paid? I got treasuries that mature from 2041 to 2048. I sleep well at night. I have no cause for concern. If we're going to assess the credit risk of treasuries, if we use a structural model, we need a balance sheet. We put our liabilities over here. We have to have some notion of equity and we have to have some notion of assets. Well, all we know is we got about 37 trillion over here. What about the assets? What about all the assets it has? What about all the spectrum it owns? What about all the mineral rights that it owns? What about all the extraction rights? What about all the water rights? What about all the land, all the assets, all the buildings, all the military equipment? What about everything that it owns? Is not listed here. If it were, you would have equity. And then you could start to use a structural model to say, well, if it was credit risky, what would be the credit spread? The other thing is all the debt is denominated in US dollars. They control the printing press. They have the Treasury. They also have taxation. They can tax their own citizens. So what kind of credit spread would you want on this? I'm of the opinion there is no credit risk here. What's interesting is there are CDS on this. If I could, I can't, but if I could, I would sell that stuff all day long because to me that seems like free money. And I think everyone thinks it's free money, so I think even though there's CDS, I doubt if they're liquid. I doubt if there's anybody on the other side. So we are here. I really do believe we are still credit risk free. So what is going on with the long end of the curve? Inflation expectations. Well, the break-evens tell us no, they're well anchored. They're not there. So it must be some reflection of growth. The higher the rate of growth, the higher the real term. That's not quite how that works. It's that if you have a 10-year at 4% and you have a higher level of growth, or you're expecting a higher level of growth, it means that inflation's probably not going to show up, because if it did, rates would rise and you'd have a lower level of growth. So the inflation component here would be low. Let's say 1%, you'd get a 3% real rate. Whereas if you had a 4% 10-year yield and you expected higher inflation expectations, a lower growth environment, your real rate would be 1% to match that lower rate. So that's the way that interprets. So I think we're up here. I don't see any credit risk. I don't see any credit stress, and there is no credit crisis. So let's have a look at going forward, what is supporting duration. Stable coins are a big thing. This is going to be part of the Genius Act. Walmart and Amazon announced that they're looking at this. Why? They want to bypass those card processing fees, plus they get the carry. They have corporate treasuries, which put their money, their cash into cash equivalents, which are money market funds anyways. To the extent that they can increase their assets, which would be the cash that they hold or the treasuries that they would hold, based on consumers holding balances of stable coins, they get a carry, right? So if they're just taking their own money and putting into treasuries, that's what they're doing anyways. They're putting it into T-bills. But if they can issue their own stable coins, and there is a population of people that hold these stable coins, they have to give cash to Walmart and Amazon to get the stable coins. Walmart and Amazon takes that cash and puts it in money market funds. They get the carry, again, to the extent that the marketplace is willing to hold balances. JP Morgan and a bunch of the larger banks are saying, hey, we better get in on this because these guys want to bypass us. If we get in on this, we can replace our card processing fees, plus we get the carry to the extent that they want to hold balances. This, to have a stable coin out there, increases the demand for T-bills right away, because you have to secure it with something such that the stable coin holds its value of $1. The best way to do that is with T-bills, but T-bills have a return. And the Fed has set the return to be within a particular range. So it doesn't matter what the demand for the T-bill is, you're going to be within that particular range. If there is not enough T-bills to go around, you can engage in reverse repos. In other words, provide funding. Walmart and Amazon or JP Morgan can say, okay, well, we can't buy any more T-bills. We own all the T-bills. We need more money market funds. They can create a money market fund by lending into the repo market. And how that works is I will buy a 10-year treasury, but I don't want to pay for it. So I'll go to you and I'll say, I'll pledge this as collateral and you lend me money against that. And we'll do that for 30 days. And I'll come back and I'll rebuy it from you in 30 days. That's why it's called a repurchase. I'm selling it and then repurchasing it. So you're lending money for 30 days based on collateralized 10-year treasury. So you're using a 10-year to create a money market fund. So that's all that would happen, is that the amount of funding in the repo market would increase. Well, if you have all of this money that needs to buy money market funds, you're going to squeeze people out of the money market altogether, because there just won't be enough securities to go around. Well, they can go into the 1 year, they can go into the 2 year. Besides, this is not just T-bills, right? It is cash or near cash. So they could go into a 1 year or even a 2 year. They could have some duration component for some part of what they're holding. That would tend to start to push more money out onto the curve. Not because of any lowering of rates where they're buying, just because of a shortage of securities. You'd have no choice but to say, well, I got to buy the 2 year, the 3 year, the 5 year, the 7 year. Well, that will squeeze a lot of volume out of the 2, the 3, the 5. When I say volume, existing volume, we'd have to say, well, there's not enough securities now. I have to move further. Now, that's a capital market curve. That can be bid up. So this has the very real possibility of flattening the curve all along as you keep pushing people further out on the curve. If you can monopolize the money market and own most of the securities there, the only way that I'm getting a money market security is by offering repo funding to that market, which then increases the demand for everything on the capital market curve. So I think that stable coins is a definite tailwind for duration. We just got to keep our eye on the Genius Act. The faster that gets through, the better. Strong auction demand. Let's look at some Treasury auctions here. And I have, I think I have that, where are we? There's Treasury Watch right here. Let me drag this onto the screen. There we are, and I've got the results from the Treasury auction up. Let me just close that so you can see where I get it. Quick strike tools, and what quick strike tool am I looking at? The Treasury Watch. So if you're on CME, you just scroll down here. There's Treasury Analytics. We don't want that. We want Treasury Watch. You'll get this screen up right now. There's the Fed balance sheet. Here's Treasury auction tool. Just you click on this menu and you show detailed chart. Here we go. All along the bottom are your bonds. Let us take the 30-year and let's just get rid of everything else so we can isolate the 30-year. This is the size. You can see over here 24 billion, 18 billion, 12 billion, 6 billion. So if you hover over it at the very top here, it tells you the size and the bid to cover. 252, 233, 237, 243, 231, 243. What does that mean? That means for every dollar being auctioned off, there is a bid to cover of $2.43. So that means that instead of issuing 22 billion based on the bid to cover, if you gave everybody their bonds, you could go 243% or 143% higher. 243. This is the last 6 months. Here's a year. This is 2.3, 2.31, 2.38, 2.5, 264, 239, 252. All in the twos. Let's go with 3 years. Look at this line here is the one you're paying attention to, not the straight lines up, but this jaggedy line. Do you see an issue? I mean, here was an issue here. This was the lows, the lows of November. 2.24, still $2.24 bid for every dollar offered. So if we think about it in terms of the demand for treasuries, the 30-year is still there. Let's look at the 10-year. Look at the bid to cover. The bid to cover has actually been increasing in the 10-year. If you take this going way back here 3 years and you look at where you are, the line of best fit would be an upward sloping line on the bid to cover. There is no shortage of demand for the 10-year. What number is this? What's our bid to cover here? 267, 260, 252, 259, 248, 27, 258, 248. You can see it yourself, and it is an upward sloping line if you did a line of best fit. Nothing here with the 10-year. Let's look at shorter time frames. Let's look at the belly of the curve, the 7 and the 5. Actually, it gets complicated looking at 2. Let's look at the 7. And again, the bid to cover. You could see a slightly upward sloping curve on the bid to cover. You see that? Slightly upward sloping. Look at these bid to covers here. 2.76. This one here was a light one at 242, 253, 255. The last one was 269. Right? This is not like it's 1.1, 1.2 and you're barely placing it. Let's get rid of the 7. Let's look at the 5. It's kind of sideways on the 5. What we got here? 233, 241, 239. This one over here is 240. Another 240, 243, 239. All decent. Look at the 2-year. And the 2 years being fairly in a fairly flat range all the way through. A bid to cover 256, 272, 266, 287, 252, 269. Okay, I think I've made my point. Let's get that off the screen. Right? As far as auction demand, we've looked at that tool. There's strong auction demand still. So it's being bought. What's going on here? You have historically high short interest. This will create downward pressure on treasury prices. Investors are still stepping in and buying these things. Pension funds are looking at these yields on the 10-year, on the 20-year, on the 30-year, saying this solves so many problems going forward. Thank you very much. Lots of bigger endowments, foundations, even individual pension funds are saying, I can get this yield. I'm holding treasuries. I bought them at the October lows when the yield started hitting 5.5, 5.6%. I'm holding them. I have a bunch of zero coupon bonds for 2041. That means no interest. You just buy them at a discount and they mature at par. So you have lower currency risk on day one, and you have no withholding because there's no interest payment. That's beautiful, and you're getting nice big duration off of that. Historically high short interest, TLT, depending on where you get your data, it's anywhere from 19 to 24% of the float. 19 to 24% of the float. This is a proxy for what the retail market is doing. But you think, well, TLT is not the bonds, it's just the ETF. The ETF has to hold very close to the price of the bonds, so you could short this all day long. It's not going to do anything, is it? Yes, it will. Let's say that this is the market value of the underlying, and TLT is coming under shorting pressure, and it was priced at its net asset value was priced equal to its underlying. Comes under selling pressure, it's going to create a gap between the price of the underlying and its net asset value. When that gap gets wide enough, sponsors, the authorized participants, will then take advantage of that. The sponsor every day for an ETF lists a redemption basket and a creation basket. A redemption basket means you hand them ETF shares and they'll give you bonds. Creation basket means you hand them bonds, they'll give you ETF shares, and it's meant to arb, make sure that there is some mechanism to arb the price of the ETF with the underlying, so that it doesn't get too far out of line, so that at any given time it's very, very close to its net asset value. So the market is shorting shares on TLT. This gap opens up, and for ARB you follow the big rule in the market, the very big rule: buy low, sell high. Buy low, sell high. Well, here's the ETF, here are the bonds. What are you going to do? The authorized participant's going to start buying ETF shares. When they get enough ETF shares, they're going to go get the redemption basket by handing the sponsor the ETF shares. The sponsor will hand them the bonds, which are higher priced, and they'll sell the bonds. Not because, oh, we don't want credit. They're selling the bonds because the market opened up an arbitrage opportunity between the ETF price and the bonds. So let's sell the bonds. Look at the short interest. That has put selling pressure on the portfolio, and their portfolio has an average maturity of 25 years. It's a 20 plus ETF, which means they hold bonds in the 20 to 30 year range. That is where we're having the problem, is on the long end of the curve. On Friday, there was every reason to be in treasuries. You had benign CPI, you had benign PPI, you had a very good 30-year auction, and you have a crisis brewing. Not crisis, exploding, literally, in the Middle East. Every reason to be in treasuries. And it sold off throughout the day. It sold off because I think the market is on a narrative, and they're going to keep playing that narrative regardless of the changing underlying fundamentals. The narrative lasts longer than the fundamentals. When the narrative can't handle the fundamentals anymore, when you can't continually say we're ignoring this, we're looking past this, at some point the fundamentals say you cannot ignore me anymore, you cannot look past this anymore. This is the reality on the ground. The reality, as soon as you get the Genius Act, the reality is there's going to be demand here. And I believe stablecoins will happen. The reality is you have strong auction demand. The reality is the short interest is creating the selling pressure, not the investors. That would show up here. That would show up with some kind of credit stress. If you had very low bid to covers, you could say we now have credit stress. We don't have credit stress. Futures. This is where you're going to get the institutional side. This is a proxy for retail. Let's look at institutional short interest. 1.85 million contracts as of June 3rd. You might say, well, how can you have short interest? Wouldn't you have just as much long interest? It's a contract between two sides. You take dealers and market makers out of the equation. You eliminate them because they will hedge their book. They're not in it to play, so they'll hedge their book. So based on positioning, you could figure out if the market is net long or net short. Short interest, 1.85 million contracts. The dealers must sell bonds because an institution sells a futures contract. I'm going to sell the futures, which means the dealer or the market maker must buy the futures contract. If you buy the futures contract, it means you're going to take delivery of the underlying bonds. So they will short the bonds now, so they have no price risk. When they take delivery of the underlying bonds, it covers their short position. So you have short interest. You have selling pressure because of the short interest. You have selling pressure here because of the short interest from retail and from institutional. This is a very crowded trade right now, but it is the narration. It is the narrative out there that doesn't match the fundamentals. That is the narrative. Also, on the horizon, you have a very, I think, big deflationary wave. Because in terms of where the models operate at the level of declarative knowledge, conceptual and procedural knowledge, these things are killer. If there are elements of a job that have elements of those types of knowledge, AI is going to massively increase productivity. If there are jobs where that is all you do, AI will eliminate that job. Businesses are brutally efficient when it comes to these kind of costs. Managers will do that. Managers will say, look, my compensation is tied to my division's performance. I have 7 people. Can I do it with 6? My top 2 people tell me that they can get it done. I believe them. And boom, one guy can go. And I don't need to hire anybody coming in. So that will happen. You have a deflationary wave coming. You have very strong auction demand. You have a huge pent-up demand that is going to be unleashed with stable coins. I do think that this is the killer app for crypto, not Bitcoin. I don't think that will survive. I think the stable coin makes a hell of a lot of sense. And then combine it with this. This is your culprit right here. This is the guilty party. And what are they doing? They're playing a narrative. They're playing a narrative. Well, a narrative gets played until you get to a point where you have this big correlated strategy and this big crowded trade, 19 to 24%. Again, depending on where you can find your numbers, call it 20% short interest on TLT, almost 2 million on the contracts. All of that creates selling pressure, but the selling pressure is based on the positioning of retail and institutional that are not investors. They're simply traders. They're following a narrative, much like the equity market right now is following a narrative. I think the equity market is wrong on both small cap and large cap at this point. If we expect deregulation into the future, if we expect the Genius Act to pass, if we expect AI to do what AI is doing, there is no evidence that there is stress in this market. If we expect that there is going to be a reversion to the mean in terms of economic profit, there will be a reversion of the mean on the multiple. My position is short beta, large cap, long beta, small cap, long duration. Not the Friday that passed, but the week before. You remember last week I said after the market closed, I bought another 2,000 shares of TLT. I still have them. If TLT continues to pull back, I'll look at the 20-year auction on Monday. We get that at 1 o'clock. You get a bid to cover of 2.4, 2.5. I see no reason why I would not want to buy even more TLT. Remember the rule in the market: buy low, sell high. What is low right now? Duration. What is high right now? Large cap beta. And that is what I'm doing. And from week to week, the price will either work for me or it won't work for me. But I'm in this for a longer term period. And when I am short, I am tactical. So for those who are overly concerned about my position, who ask me every week, how's that short position doing, buddy? It's doing just fine. How are things working for you? Anyways, we'll leave it here. I think the big risk right now this week coming up, I don't think the Fed is the big risk coming up. From where I sit, It's now 10:33 on a Sunday. I have no visibility on how the market is going to interpret what's going on in the U.S., and I have no information on what Trump is going to do in terms of against or for Netanyahu. He did say don't do anything, but Netanyahu went and did it. Not on my watch, Trump says. Never would have happened. Oh, hang on. No, it's all the stuff that never happened, that happened when he wasn't president, would never have happened when he was president, but this one did. Now Biden can say, not on my watch, never would have happened if I were president. I wonder how he's going to handle that one. Either way, I think he's going to certainly back Israel, and on this one, I agree. You cannot let the clerics, now not that I'm saying Iran, you can't let the clerics get a nuclear weapon with, I think, their extreme position in their ideology. Have their ideology, but, let's have a separation between the church and the state, which I think probably would benefit all of Iran. I have a friend who is from Iran and says it's just a beautiful country except for the clerics. You have to get rid of the clerics. This could be a good prelude to a regime change if they lean into it. I think that is the big risk. So, are we going to have it fizzle out into nothing, or are we going to have sort of a Darmok and Jalad Stein at Tanagra? Let's find out.